What's up, everyone? It's Karthik with MoneyVest. So this is going to be your update for the day as we get started here. Volatility is on the rise once again. So we are up a little bit over 11%, back up to over 23. And as we know that volatility in the month of September is usually pretty elevated. I've talked about this in our previous updates that we tend to see VIX on a average basis at close to 25, on a median basis at over 20, and we're already over 23 after the 37% increase from yesterday as the markets continued to sell off slow and steady. There was a lot of bleeding. There was a lot of significant weakness intraday as we continue to make lower highs and lower lows. And again, I've got lots of things to break down in this video. I'm going to go over exactly why there is so much selling pressure from institutions and why there is so much rotation away from technology, away from semiconductors over to other parts of the market. So hope you all enjoyed this video and find it helpful. Make sure that you drop a like and subscribe to the channel. And do me a favor, please share this video with your friends and family, other traders and investors that can benefit from the value of this video as well. I would really appreciate that. So I've got one word for all of you, and that is uncertainty. Markets absolutely hate uncertainty. When there is a lot of uncertainty in the markets, by default the reaction, or by default the action really is selling pressure. We tend to see a lot of selling pressure in the markets when there is a lot of uncertainty, where investors, traders don't know what the near-term future looks like with regards to interest rates, with regards to the economic conditions, with regards to inflation. And all of that is getting baked into this market, and we're dealing with a lot of uncertainty. That's what's causing investors to kind of flight a little bit more towards quality and safety here, as investors ditch technology, semiconductors, some of the high flyers such as Nvidia, Tesla. We got Magnificent Seven, and moving a little bit more towards the defensive parts of the market. And if you essentially move forward, the uncertainty is stemming from really just three questions. If I were to really drill down to what is the uncertainty all about, there's really three questions the markets are trying to answer. Number one, and the most important, is, are we going to see a recession or not? Right? That's the most important question, perhaps. And the reason for that is because if you do see a recession where there's a lot of economic indicators suggesting for one, because the uninversion of the yield curve, we've been inverted for well over 700 days. We got the PMI manufacturing index, the ISM manufacturing survey, contraction 5 straight months in a row. So there's a lot of indicators suggesting for economic contraction. And the big one is going to be the jobs report later this week. And all of this is really going to help us answer this one question, whether we see a recession or not. Because if we do see a recession, the bear market, the selling pressure can be longer lasting and more severe. On average, as we already know, markets tend to go down over 36% in a recession. That's when a recession is accompanied with a bear market. And it also lasts over 16 to 17 months. So if I show you the chart that I've talked about in my previous videos, and something that we have, again, discussed several times over, I've done a lot of research on this particular topic. If you come over to S&P 500 bear market declines, this is essentially a spreadsheet showing us the decline in the S&P 500, right? So during the bear markets, 67 years worth of data going back as far as 1957. And this is the decline here. This is whether we did witness a recession or not, yes or no. And this is basically the overall summary. When there is a recession, we tend to see a 16 to 17 month sell-off, right? So S&P 500 still hasn't taken out its all-time high yet. We were down a little bit closer to 10% from all-time highs when we did witness the sell-off on Monday, August 5th. When the Nikkei was selling off, there was a lot of panic around the yen carry trade. Volatility spiked over 65. Then we saw a very nice V-shaped recovery, but we didn't quite take out the all-time high, and we're now starting to rotate back lower. We've broken down a pretty significant support level for the S&P. So, when there is a recession and there is a bear market, we tend to see that last for 16 to 17 months. This is not the recession timeline. This is the market bear market timeline. And the average or the median sell-off is anywhere from 35 to 36.5%. And when there is not a recession, as you already know, it is very, very short-lived, only 6 to 7 months. And the average median sell-off is about 20 to as much as 23% for the entire market. So the first question is all around, whether we're going to see a recession or not. And, the second one, of course, is going to be whether we see an economic recession or whether that translates over to an earnings recession. Now, these are two very, very different terms, and I want to make sure that everybody understands the difference. Earnings recession is not the same as an economic recession. Economic recession has more to do with the actual economy, the productivity, the unemployment rate, the manufacturing index, construction spending. There's a lot of actual real factors at play that are seeing significant declines. And as a result, that leads to 2 consecutive quarters of GDP and productivity contraction, right? So productivity and GDP actually declining on a year-over-year basis for 2 consecutive quarters. And that translates over into an economic recession. Earnings recession is very different. And the reason why this is so different is because it's got more to do with the S&P 500 companies and what's the earnings actually doing. And are they actually growing or are they declining on a year-over-year basis? We actually did witness a combination of these two things. We actually seen this in 2022, a little bit in 2023 as well. But the NBER, the National Bureau of Economic Research, never really declared a recession because unemployment never really went up. And now we've got the tidal wave of unemployment accelerating higher, economic conditions weakening, right? So on the surface, it may still seem like, we've got the GDP growing at 2.8%. That's clocking in a very strong rate. We've got retail spending and retail sales coming in strong. We've got inflation trending lower. So on the surface, it may seem like we've got a very strong economy, but there are a lot of other indicators that are suggesting anything but, as we have already discussed in our previous updates. For example, delinquency rates are going up. We're seeing the total credit card debt going up, total accounts, credit card accounts going up significantly, the ISM manufacturing index, construction spending, inversion of the yield curve. So there's a lot of factors that are both for and against a recession. But the earnings recession, in my opinion, is going to be a more important type of recession. And the reason for that is because the S&P 500 really only cares about the earnings. And in a sense, if there is an economic recession, earnings recession essentially follows. And the reason for that is, again, if unemployment goes up, people are not going to be spending as much. They're going to be shifting their spending away from discretionary items over to a little bit more defensive, and they're going to be in savings mode. And as a result, that's going to translate over to the company's earnings as well. They're not going to be using as much credit card anymore. And again, they're going to be in a pretty tough spot, right? As we already know, savings rate has depleted down to under 3%, lowest levels we've seen in many, many years. And for that reason, I think the consumer is really now starting to feel the pain of higher interest rates that have been around for well over 18 to 24 months here, as we've started to now really witness the pain and the struggle with higher interest rates. And it's really pretty much high time now the Federal Reserve decides to lower interest rates at some point. Now, for those reasons, I think it's really important to also understand that volatility, seasonality-wise, it's expected to go up. Like this right here is the expectations for the VIX, and this is essentially showing us the average volatility index reading in the coming months here. So we're looking at September, October, November, and December, something that we have again demonstrated through different spreadsheets in our previous updates. And again, we're just a little bit over 20 right now as of the time of this video. But seasonality-wise, it can get up to over 35 to 40. Of course, we witnessed over 65 back in August, and August seasonality wasn't supposed to be this high, so this was a little bit of a event that blindsided investors with the yen carry trade. But September going into October and November, there's expectations for higher and more elevated levels of volatility, especially when you combine that with the FOMC meetings, inflation data, unemployment data, as well as the US elections. So we got a lot of things that are coming up for the market. And when it comes to the global liquidity index, we're also expected to see some increases in the overall global liquidity, right? So as interest rates cuts continue to come in, we are expected to once again start to accelerate back higher, which is going to be one of the ways that central banks all over the world try to avoid some type of a recessionary environment, right? So that's one of the ways where central banks are really focusing on the soft landing scenario, where we don't really see the economy get worse from over here. Oil plummets as demand continues to come down, and we did see Brent, which is a good thing actually for inflation and for consumers' wallets as well, as it continues to plummet down to $70 a barrel or even lower. But this right here is really just showing us the equities performance after the Fed cutting cycle starts, unless growth is weak. And we've got a lot of different scenarios over here. Some of them are suggesting for average movement in the S&P 500 performance if there is a recession, and if there's not a recession before 1990 or after 1990s. So this right here is where we can see a lot of choppiness. So going into September 18th is when the Federal Reserve is expected to cut rates. there can be a lot of choppiness. There can be a lot of back and forth here from the markets, but it's really after what happens after the rate cut is what really matters. And a lot of that depends on the question that we come back to from the beginning, whether we see a recession or not. Because if you do see a recession and post 1990s, the market's performance has been very, very lackluster. We've seen it perform worse in the coming months, as opposed to when there's not been a recession. Even if there has been a recession before 1990s, we actually tend to see very, very significant growth here for the market 6, 12, 18, and 24 months later. But when the Fed cutting cycle begins and it's accompanied with a recession post 1990s, we have seen the markets with a very lackluster performance 6, 12, 18 to 24 months out. Now, U.S. manufacturing activity contracts for a fifth straight month. So ISM August factory index down to 47.2 after 46.8 a month earlier. So we did see a little bit of an increase, but anything below 50, as I've already mentioned in my previous updates, is expected to see the markets, or the economy rather, in a bit of a contraction. And we have been below 50 for a very long time, since basically September. It looks like October, December of 2023. So it's been quite a few months that we've seen contraction for the U.S. manufacturing, right? And manufacturing and construction are actually one of the leading indicators for how well the economy is expected to do, along with the initial claims, unemployment rate. The yield curve can give us a little bit of insight as well, but it's really coming down to manufacturing, and again, construction, which translates over to productivity in the US as well. So these are some of the indicators that people are really trying to extrapolate more information from, and kind of really trying to understand whether this leads to a recession or not. And as I mentioned before, just be prepared for a recession. Even if you do see a mild recession, I think it's really important for people to be prepared. Cut down on all expenses, really pay down high interest debt, have an emergency fund, have savings, have some more additional cash and liquidity on the go for opportunities that may present themselves during times of recession, because it's really during times of recession that the best opportunities come knocking to your door, and you better be ready with your checkbook, because that's where you're going to get the best deals. The group's measure of production slid for a fifth month deeper into contraction territory to the lowest levels that we've seen since May 2020, and the gauge for new orders, which showed bookings and are shrinking, dropped to 15-month low. Export orders also shrank at the fastest rate since the start of the year, and declining orders and a persistent retreat in backlogs remain headwinds to production and illustrate a struggling manufacturing sector, while the ISM gauge of factory employment rose, is still showed a third month of contraction as well. We got the PMI manufacturing numbers today. We've also got the JOLTS numbers coming out later today as well. And this right here is really just showing us the consumer price index, also showing us the capacity utilization for our manufacturing and of course for construction. So as it continues to come down, we do start to see that consumer price index is also following suit. So inflation tends to come down as we are seeing this the capacity utilization come down. So that again is something to keep in mind. And also this is the opposite of how capacity utilization comes down, as continued claims, which is initial claims, right? How many people are filing for jobless claims, continues to go higher. Now, one more thing that I want to break down is the unemployment numbers. Now, that is going to be coming out later this week, so on Friday, and my eyes are going to be on the unemployed persons. How many people are actually unemployed in the US of the participating population, which is currently sitting at about 166.5 million, because the unemployment rate is nothing but a calculation of unemployed persons divided by the participating population, and that's how we get the unemployment rate, which is currently sitting at 4.3%. Now, if this number accelerates to the upside, if this number actually goes up to, let's say, 7.2 million, we're going to be looking at a few more decimal points of 4.32. If it goes up to, let's say, 7.3 million, now we're going to be sitting at almost 4.4% for unemployment. So we really want to see this number come down in order for us to continue to believe there is a possibility of a soft landing. Now, there's also some concerns that if this jobs report comes in too hot, right, meaning that it actually shows us a very, very strong labor market, and let's say for whatever reason this number comes back down to 7, and we're down to 4.2%, that I think is going to be the most appropriate report. If we are a little bit too extreme on either side, meaning that let's say that we come down to 6.75 and unemployment rate drops to, let's say, 4.1 or closer to 4%, there's possibility that the Federal Reserve starts to backpedal some of their rate cut expectations. Although 25 basis points is pretty much a done deal, in my opinion, by September. But for future rate cuts, there could be some uncertainty once again, right? Is the Federal Reserve going to cut rates more aggressively in 2024 or not, if unemployment actually is back down to 4.1 or closer to 4%, because that is a strong unemployment rate. And at that point, NBER is also going to reevaluate whether we are really seeing weakness in the economy or not. But the truth is, I think unemployment rate is also not being reported correctly. We've got so many people with double full-time jobs, and I really have no idea how they're being accounted for in the unemployment rate. We've got a lot of part-time workers. We got a lot of people that are working two full-time jobs. We hit a new record high of number of people that are working two full-time jobs in the United States. I think that number was like at 477,000 or something. And that's actually crazy how many people are working two jobs to survive and to actually make enough income to get by in these higher inflationary environments and prices, of course, that continue to go up. So if you do get a very strong print on the unemployed persons, in other words, the jobs report, then there's a risk to the downside where the Federal Reserve starts to backpedal on interest rate cuts, and the markets may not like that very much. And if we actually see that worsen further, let's say that we get up to over 8 million and this number jumps to 4.4, 4.5, 4.8%, then there is a much bigger risk, because then the economic recession uncertainty is going to elevate even further. And then there's going to be a little bit of a panic mode where the markets may expect the Federal Reserve to cut more aggressively, maybe not 25 and up to 50 to 75 basis points throughout the course of 2024. And that's going to create a little bit of a panic situation as well. So really the best case scenario for the jobs report this Friday is something a little bit more along the lines of 4.2 to 4.3%. If you do see this number accelerating at 4.4, I think that's not going to be taken well by the markets, because those recession expectations and that uncertainty around those recession expectations are going to only increase further. So that is something to keep in mind. Now, when it comes to the Magnificent Seven, we are down a little bit over 12% from our all-time high. So we're currently in here in the correction territory. So again, I've been taking note of this entire spreadsheet, and as of September 3rd, down a little bit over 12% from all-time highs to down to its lowest point. And we haven't really hit new all-time highs yet. So that's actually been one of the weakness in the markets, because if you come over to the NASDAQ here, what you'll notice is a very clear lower high. So this right here was the all-time high, and we didn't quite get up to the all-time high here for the NASDAQ composite. We made a lower high, and it's possible that we actually on our way to potentially making a lower low if this selling pressure accelerates further. So that again reminds me a little bit of 2022. For those of you who were not investing in 2022, we essentially saw a significant bear market which lasted for many months. So if you come over to 2022 here, this is what it looked like, because we were essentially making lower highs over here, and you'll notice the markets continued to make lower lows along the way until finally bottoming out in October of 2022. So that was an entire year of lower highs and lower lows and continued selling pressure. And the reason why yesterday's sell-off kind of spooked me a little bit and is a bit more concerning than other sell-offs is because we actually did not see any buyers step in whatsoever. We did not see any bids throughout the day. We continue to make a lower high and lower low, especially a lower low. We continue to make a new low of day for the entire market. And same thing is true for SMH. SMH is one of the indexes which I would argue kind of leads technology, and we just made a lower high here. This right here can be argued as a bit of a horizontal low. So if we take down this support of $201, and if for whatever reason SMH ends up trading below $200, then I think that's a big warning sign that we are indeed in a longer lasting bear market, which then the question then becomes whether that's accompanied with a recession or not. And finally, if you come over to Nvidia is going to be the one that kind of leads the market a little bit. It's down another 1.3%. And if I scroll back a little bit on this entire chart, it's overall done incredibly well. Very nice uptrend and higher lows. So if you do tend to see a bit of a mean reversion, which is possible. Look, Nvidia has seen 60-70% sell-offs here, 54% over here, 67% over here. So it's not unlikely to expect another 60 to 70%. I'm not saying that's going to happen. I want to be very clear before everybody starts attacking me. I want to be very clear that this is simply based on the fact that in the past, Nvidia has gone through these 50 to 60% contractions, and that can be labeled as a bit of a mean reversion for Nvidia. However, before we even get down there, I think there is very strong support. As you can see over here, it's been a little bit more elevated, but there is support for Nvidia. Boom, right here, support, and that's going to be that next level, kind of also aligned with another steeper higher low. However, I've also pointed out for a potential head and shoulders here. So you can see that left shoulder with a head and then a potential right shoulder formation and a bit of a tilted neckline for Nvidia as well. So if we continue to see some selling pressure to the downside for semis, if they don't get bought up here fairly quickly, then there is more potential downside. And I would put down a $95, $96 target in the short term for Nvidia, which is a possibility. Again, just based on technicals and based on the overall sentiment around the markets right now. So that's where we are. Keep a close eye on volatility and keep a close eye on the significant market uncertainty. We are certainly making lower highs right now. So even if you come over to NASDAQ 100, very strong lower high printed on the NASDAQ here. So we weren't able to break out. And that's, again, putting us down a little bit over 12% from all-time highs. We are now in the correction territory once again, which is where we have spent majority of that time. 84% of the times this index has spent within 20% of their all-time highs. So this is the current reading. If you drop over 20% from all-time highs, we'd be in a bear market where, again, we've spent over 90% of the times. This is going back over 10 years worth of data. And I'll keep you guys updated with where we are on the MoneyVest dashboard as well as the unemployment numbers as well. So let me know your thoughts down in the comment section below and what are your expectations for the markets and more specifically for the economy as well. And as always, make sure that you drop a like and subscribe to the channel. Links to our Discord and Patreon is going to be down below. Happy investing. I'll see you all in the next video.